evening, everybody. Luke Gromen, FFTT. Hope everybody's well here on this Monday night and had a great weekend. We've got the two things that grabbed my attention recently. We're going to jump right in. I've going to try to run through a few questions, and so here we go. The first thing that grabbed my attention recently was an article over the weekend in FT Alphaville. It was highlighted by Raoul Paul. The title of the article was "There's a Black Hole in the Dollar Funding Market," and I thought within it there was it's a fascinating article. It's a free article. All you have to do is register for FT Alphaville. I would highly recommend reading it. There was a line in there that really grabbed my attention. It ties into a lot of what we've been talking about recently in our public appearances and with customers, which is that the quote was this: "In short, there are too many dollar-denominated safe assets in the market and not enough liquidity, and hence, very possibly, the makings of a fresh liquidity crisis." And this was a quote from Zoltan Pozsar at Credit Suisse, who's one of the foremost experts on the plumbing of the monetary system. We've talked about a U.S. fiscal crisis being Voldemort. In other words, it's what you're not allowed to talk about or say the name of. And the punchline is too many dollar-denominated safe assets, not enough liquidity. And this is what we've been saying, which is that it's a balance sheet capacity issue relative to U.S. fiscal deficits in the context of a weak, really non-existent growing foreign central bank demand and weakening foreign private sector demand as a result of FX hedging markets. And so I thought it was a really important milestone in terms of just highlighting it's starting to be very well understood, and once it becomes more and more well understood, it leads down a path that you really, once you see this, you can't unsee it. And what it ultimately leads to is significant dollar liquidity injections are going to have to come sooner rather than later. Number two, the second thing, as you guys might imagine, Mark Carney calls for global monetary system to replace the dollar. Extraordinary, in my opinion, in terms of not only what was called for, but as I think somebody I follow on Twitter noted, I think it's the first Western central banker that has called for a replacement for the dollar, and that makes it, from the BOE no less, really an extraordinary development. Interestingly, what he's calling for was called for by Zhao at the PBOC over 10 years ago. Russia, etc., any other number of rogue, quote-unquote, rogue nations have called for this. Ultimately, this is the fix to the world. Triffin's dilemma, it's the fix to Triffin's dilemma in terms of the reserve currency also being the reserve asset. And so it would, I think, be a great fix for the global economy. It ties a lot into what John Keynes proposed at Bretton Woods and was turned down in favor of the dollar-centric system. If you had a neutral settlement asset, whether it's Libra, whether it's gold, etc., the world would reorder around balance of payments, current accounts. And if you reorder the big five currencies, the SDR currencies that way, around a neutral reserve asset, as Carney is proposing, the dollar would no longer be the cleanest dirty shirt, it'd be the dirtiest dirty shirt, or it would be in a race for dirtiest dirty shirt with the UK. Those two currencies would have to fall the most. Yuan, yen, and euro would likely rise against the dollar and against the pound pretty significantly. So those are the two things that really grab my attention. I'm going to jump into a few questions here quickly. First off, from Doug: do I expect quantitative easing before the end of the year? The short answer is yes. Earlier this year, we thought by the end of 1Q20 at the latest, given what has occurred this year and given the tightening dollar liquidity for reasons we discussed before, I fully expect to see QE launched by year end this year. Let's see, Matt, could you touch base on how you see the oil market developing with Russia and other nations pricing more outside of the petrodollar system? So 10 years ago or more, I guess it was more than 10 years ago, I'm getting old. When I was in the institutional equity sales business, or on the institutional equity sales side, we would travel with companies. I traveled with one of the biggest commodity traders in the world, the CFO of one of the biggest commodity traders in the world. And he said in numerous meetings, in commodities, the marginal ton prices the whole. And the reason I bring this up is when you think about multi-currency energy, that's what you need to think about. It doesn't matter that only 4 or 5% of world oil, if Rosneft invoices in euros, it doesn't matter it's only 4 or 5% of world's oil. The marginal barrel of oil and oil products is being priced in euros, not dollar. And we've obviously already talked about how the marginal barrel of oil being priced in yuan. Suddenly, what all this means is that the yuan dollar cross rate and the euro dollar cross rate become critically important to determining the price of oil. And so if we get a dollar spike, what that means is that oil is going to fall sharply. If the euro and yuan weaken against the dollar, oil in dollars will fall sharply through those cross rates, with all that implies for U.S. industrial production, U.S. economic growth, shale, etc. Let's see, Duke. FX began the week with sharp moves in yuan, Mexican peso, Turkey, New Zealand, all falling against the dollar, and yen up as a safety trade. The question is, the tell we got seems to signal a chaotic FX scenario. Does this align with your weakening view of the dollar? I think it ultimately does, and I think the reason we're seeing this tightening ties back to that first point. U.S. deficits are crowding out the world. There is, as far as I know, not an example in history of a government going broke for lack of fiat currency. Nobody's more short dollars than the U.S. government. The dollar strengthens meaningfully. I fully expect the Fed to fund any and all U.S. government deficits that they need the Fed to fund for them. And so, as we've been saying, could clearly see the dollar rise in the short run. I just don't think it's going to be sustainable and maybe not even very tradable, because a rising dollar or a dollar spike will cut the U.S. government off, and the Fed won't allow that to happen. The U.S. Treasury won't allow that to happen. Let's see. James, charts showing the dramatic growth of negative yielding bonds are being pushed around Twitter now. Strikes me as a true bubble, especially for corporate bonds, i.e. an unsustainable situation. What's your take? I would direct you to an article. I think you can find it online by Russell. His last name's Horseman Capital. His last name has escaped me, but the first name's Russell. At any rate, he looks at sovereign debt as long-term currency futures, and makes the point that the fact that the dollar and yuan sovereign debt are priced positively while others are priced negatively is a sign that markets are saying the dollar and the yuan need to fall against a lot of these other currencies, which I thought was a really interesting point. And I think that's exactly what the FX hedging markets have been telling us since late last year. Let's see, MF. Why are prime brokers buying up so much treasury supply, not selling it into the market? The banks have definitely benefited from mark to market. Are there any other benefits to this hoarding? I think the primary dealers are buying as much supply, not out of choice. I think they have to. That's their deal. The U.S. Treasury auctions cannot fail. There are auctions, some sovereign auctions in the world that can. Treasury auctions are not one of them. The primary dealers are on the hook to buy it, and they're buying it. And so this then ties back to that initial story about the black hole in the dollar funding market. U.S. banks and a couple big banks in particular, increasingly, having to take down more treasuries than they want. It's a balance sheet capacity issue. It can be fixed with a wave of the wand, but ultimately that wave of the wand will have to be an injection of significant dollar liquidity that I don't think will be good for the dollar. Let's see, Jared, 30-year Treasury rate forecast as it relates to gold. I think ultimately you've seen you're seeing a real rates trade with gold at this point. You can see it in how gold is tracking with negative rate debt charts. As such, if we do get some inflation and the back end of the curve backs up, then I do think you could see a temporary sell-off in gold, but I think it would be very temporary and it would be a buying opportunity, because ultimately what we're seeing is, I think we're seeing the early stages of a global sovereign debt bubble bursting. And in global sovereign debt bubbles bursting, gold rises against pretty much every other asset out there, historically. Marcus, in your opinion, what would a Trump FX intervention look like? In my opinion, it might just be a tweet. He could instruct Treasury to buy foreign debt. He could instruct Treasury to buy foreign currency. He could instruct Treasury to bid for gold or have the Fed bid for gold. There's a number of things that mechanically he could do. There were some interesting articles talking about unilateral steps Treasury or the government could take to enforce an appropriate valued dollar back in, call it March of 2017 in the Wall Street Journal, if you want to look into a bit more. Let's see here. Finally, last question from Alex. Could you please give us your take on who the better actor is, Tom Cruise or Leo DiCaprio? He says it's clearly Tom, but he's received a lot of blowback, and he'd like me to decide, and so I'm deciding I think it's Leo DiCaprio. I don't think, I love Tom Cruise and Jerry Maguire, but I just don't feel like he's done a whole lot since 1996 or 2000 maybe, and in the meantime, DiCaprio has hit the ground running with Titanic in 97 and has just kept getting better. So that's it for tonight. I appreciate all of you joining me, and we'll do this again in a couple of weeks. And in the meantime, if you want to know what we're up to, check out FFTT-LLC.com for more information there, and also more information on our Tree Rings product, which we continue to get tremendous feedback on in terms of just being a great read for people on over the weekends as it comes out every Friday afternoon. So otherwise, everybody have a great night. Look forward to seeing you again in a couple of weeks. Take care, everybody.